Stephen Jones, you're Chief Investment Officer at the Games Capital. Which asset class surprised you the most this year?
I think the real surprise for most investors has been the resilience seen in high yield. It was the most aggressively underweight asset class in many people's portfolios at the beginning of 2018, and yet the return is second only to equities. The return has been driven by continued strong economic growth, ability for companies in the high yield market to make good money and pay coupons and redeem and refinance their debts in very attractive terms and levels.
Japanese equities, for example, are also on the rise unexpectedly for some investors. Did you expect that?
Yes, and we've been a sponsor of Japanese equity exposure and overweight that market for the last 2 years. There's very strong earnings growth coming out of Japanese companies. The economy is really doing well now, with inflation returned to normal levels. 1% is now common readings for inflation, so the deflationary concerns are gone. The Bank of Japan continues to stimulate the economy with very low interest rates, and the currency is weakening a little. The valuation around Japanese equity is also attractive relative to Europe and especially the US. And you get dividends as well. The yield on Japanese equities is above 2%, well above JGB government bond yields. So on a number of factors, we think that Japan is worth investing in. We've been overweight and we stay overweight.
US tech companies is also a big topic. Can Netflix, Amazon or Apple, for example, rise further?
I think they can. The headlines that come out of the big five names may well become a little more choppy, and we tend to look now at the second line suppliers and some of the newer technologies around some of the kit that is emerging around screens and manufacturing that is going in to provide the services that Amazon, Netflix and the like are running on. And we still think that there is good opportunities in tech overall, and it's where the earnings growth is. And there doesn't seem to be any disruption to that earnings growth going forward. So on that basis, they can still keep going up.
Are you not concerned about interest rates in the US, that they could go too high for the US economy?
Where that terminal interest rate is for the US economy, where it snuffs out the very strong growth that we're seeing, is the source of much market debate. And indeed, we've seen only recently the Fed have another view and debate about where the terminal interest rate might be for the US economy. We think it's probably about 3.25. So interest rates are going to continue to rise into the end of 2018 and on into 2019. But the momentum in growth in the US can cope with this. And we think that it will only begin to slow on the back of interest rate rises in 2020 or so.
In Europe, Italy is spreading fear among investors. Are they right to be scared?
Italy, I think, is a very specific instance now. It's very interesting that the concern about political change in Italy and the new budget from the government is confined mostly to Italian assets. We haven't seen contagion into Spain or other European government bond markets to any great extent. That says to me that Italy is separate at the moment in its attitude and effect from the rest of the EU. We think that the problem with Italy is not really their spending plans, which are high but not off the charts, but it is the cumulative total level of debt that exists in the Italian economy at 130% of GDP, and the fact that growth, even if it comes from slightly better spending by the government, is not going to reduce that anytime soon. So it's a stock concern, a total volume of debt concern that we've got about Italy, rather than necessarily the budget issues that are near term.
Turmoil in the Eurozone is always bad for financial stocks, European bank stocks especially. Are they now cheap enough to buy?
They've been cheap for a long time. And I do think that there is merit in looking at financials, certainly in the Eurozone, where they continue to, pay very high dividends, where their capital positions are much changed from 5 or 10 years ago, but where there is still a doubt about them being able to produce earnings and real growth going forward. We've been frustrated in our view around favouring banks and thinking that they should perform for some time. Unfortunately, I see more frustration to come. It's not the case that I could wholeheartedly recommend that you're going to see reward in European bank stocks in the near term.
You mentioned it last time we were talking to you 3 years ago. You recommended UBS. The share price is now even below to those days levels. Do you prefer another Swiss stock at the moment?
I think UBS has struggled in that banking sector context to get traction for the good work it's done around capital, the high dividends that you're getting out of these stocks overall. As I say, I don't see that changing. I think that in terms of your preference for capital deployment elsewhere, then you should look to higher earnings growth out of Japan, and the continued progression that we see in the US out of the tech sector.
Last question, it's getting slowly colder outside. Oil is getting more expensive. At the same time, where is your price target for oil?
We don't see it going much beyond about $90 a barrel. The structural issue around oil is actually one where the supply is in doubt rather than any great amount of increased demand. And that comes from some of the geopolitical tensions and sanctions and the like imposed by the US in particular to Iran. That's going to be a story that runs into 2019 and will keep the fear of lower supply high in people's minds. So oil at 80 to 90, I think, is something we're going to have to live with over the winter. That's not quite enough to crimp economic growth. And it gives certain sectors of the equity market, the oil and gas companies in particular, but some of the service industries as well, some very nice earnings for the next little while. And that might also be a sector to look at rather than the banks.